Hello, everyone. This is Lou Basenese, MDB Capital President and Chief Market Strategist. I wanted to welcome you today to our latest episode of Vested Interest, where I have the pleasure of always having engaging conversations with leaders in the venture stage investing space, whether they be the CEOs, inventors, the backers. Today, this conversation is an extra special treat because I think we have one of all of the above. It's my pleasure to introduce you to Dave Berkus, Chairman Emeritus and author of Super Angel and the head of the TCA Venture Group. So Dave, welcome to Vested Interest.
Hey, Lou. I'm glad to be here, and this conversation should be really interesting today.
Yeah, I hope so too. So we're going to have a talk about traditional venture, which you have been super successful in, which is not always the norm, versus a model that we espouse that, again, many have tried and emulated, but we believe we have a good solution. So I hope to have an engaging dialogue back and forth about what works, what differentiates the more successful approaches. And then again, as always, we'll open up the floor to questions and answers towards the end. I do want to encourage you over the course of this, if a question does come to mind, please use the Q&A function embedded in Zoom to go ahead and populate it already with your questions. So Dave and I can look at those and see those in advance, and that'll just make that transition to the Q&A period a bit smoother. Two other housekeeping items to cover. The first is we will be recording this. So if you want to take notes, you don't have to. We're going to be providing a replay shortly after, as soon as our production team can pull that together. And the second thing that I have to cover is some forward-looking disclosures and statements because MDB Capital is a publicly traded company. So again, we may be making some forward-looking statements today. There's various risks and uncertainties associated with those forward-looking statements. And to make sure that you properly understand them, instead of me boring you to death by reading them all right here, we just encourage you to go to the SEC website, pull up our latest quarterly filings, including our latest 10K form, where you can read about that in the risk and uncertainty sections. And then I also encourage you, there is a potential conflict of interest, but I like conflicts of interest. It shows people where your interests are truly. But we do, and executives do own MDB Capital Holdings. So we ask you to look at our latest form, CRS, that spells out all the potential conflicts of interest that may be involved with an investment. So with that being said, Dave, I want to take the chance now to give you an opportunity because I believe much of our audience is not very familiar with TCA. So why don't you tell us what is TCA and then just give us a brief background on yourself.
Sure. First of all, TCA began as Tech Coast Angels in 1998. And it was a combination of the Band of Angels, which is the duplicate name of the group in San Francisco, but the Band of Angels of San Diego and our Tech Coast Angels in Los Angeles, Orange County. And so that in 1998, there were 6 guys around a table. They had an early idea of what to do, and it turned out to be the right idea, and I'll talk about that in a second. And so they invited 44 of us to join at the very beginning. It was kind of like a fraternity pledging ceremony. And
I wonder what the initiation was. It was a capital investment, but something else, right?
So 2 of us are left out of that 44. And one of them, who is no longer left to form IFA, which was Index Fund Advisors. That's Mark Hebner.
Okay.
So he's got 15 billion under advisement. And so I'm one of his customers now. So you never know who you meet. But in 1999, we began in earnest investing in early stage companies. At the time, there was very little in the way of competition, in the way of either angel groups. There was a lot of venture capital out of the Valley. At the time, there was quite a bit of venture capital, even in Southern California, where we are. So we thought we had it all made, and I'll talk to you about my own experience in a second. And in the end, we, 2 years later, divided into 2 networks, Los Angeles and Orange County. We started as Orange County. And for those of you not in California, that's an hour's drive away. And then Santa Barbara.
On a good day, it's an hour's drive away. On a bad day, it could be a couple.
San Diego, Santa Barbara, Orange County, later on Inland Empire. And now we are franchising to areas on the East Coast and to others. Our friendly competition, the Pasadena Angels, are now part of Tech Coast Angels, or we renamed ourselves the TCA Venture Group.
I love
So
it. So, help us understand, are you bringing to bear opportunities, providing diligence, and then the investment vehicle to participate in that? What is the day to day kind of quarter over quarter function of TCA? And if I were to join a chapter?
So it started out as individuals all being exposed to predetermined number of companies each month at a dinner. It was difficult to continue those dinners because we were so widespread. So it became semi-virtual, both for the screenings and the final sessions. That is how we are today, except in 2010, at one of our planning sessions, I became somehow the manager of the very first TCA Angel Fund. And the TCA Angel Fund was called the ACE Fund. And the chairman at the time, I had been chairman, I was the second chairman of TCA going way back to 2001 or two. And so the chairman at the time said, let's call it ACE, Angel Capital Entrepreneur Fund 1 LLC. Have you ever tried to write that out on 10 documents as you sign each time you make an investment?
I can't, yeah. And there's not, for people that lack the process of going through that, there's not just a handful of documents. It's like signing a mortgage and real estate transaction times 10. So I feel for you.
Now at least we have, Carta and we have DocuSign and other ways of doing that.
Right.
But at the time, that was a pain. I said yes. I had already managed two funds, and I'm still managing one that was very successful. If you remember back to the days, 1998 and 1999 funds, almost all lost it. And we had a fund that had a 4x return, a 24% IRR, and it became one of the top 2% of all funds. And so coming off of that experience, I volunteered to manage the Tech Coast Angels funds. It turned out to be Fund 1 in 2010, Fund 2 in 13, Fund 3 in 16. And then I'm 83. And so it came to a point where I said, no, not another 12 to 14
No, I
years.
wouldn't. 83. So you give us hope to keep doing this for a long time. So,
Gee, thanks. So I said, I'm not going to do a fourth fund. So each of the
right.
chapters, in their own wisdom, decided to start their own annual funds. And an
Okay.
annual fund, which has become quite typical in the angel environment, is a combination of good and bad. The good is new members can get in. You don't have to wait until the third year to find a new fund. The bad is you're going to make all your investments in a single year. Then you're going to start a new fund. If you can believe the amount of management required and the amount of turnover over a decade, angel groups have had this problem nationwide from the beginning. Turnover is pretty great. So trying to get hold of people who have left the state, who have sometimes changed their email, often changed their phone. And then I hate to tell you this, but some of these members die. And when they die, it turns out to be their descendants, and usually 2 or 3 or 4, become members of the fund. And so we used to have a 99 or 100 person maximum required by the SEC for these non-registered funds. Luckily, about 8 years ago, they changed it to 250, and so this was no longer a problem.
So
but you can begin to guess.
Yeah. So a couple of things here that I want to tease out. One, we'll cover performance because yours has been exceptional. TCA's has been exceptional in a space that has not generated exceptional returns for the average investor. The other thing that I think is unique that I want to compare with us is this community, right? So you mentioned having a communities and geographically located of angel investors, which is not dissimilar to us, where we don't go to traditional funds and institutions. We're a collection of individual investors that have found venture stage investing compelling, but some of the drawbacks led us to do it mostly in the public market. So I think we share that in our ethos of just let's do it together in a community that understands what we're about, not ones that are motivated or have other interests that could impact their behavior in the funds. So let me ask you just why don't you share some of your success? So if I look, we were talking early right before we came in here, you started out in the record industry, wisely saw that was not going to last and pivoted to the computer industry and some coding that's actually still in use today. So help us understand your philosophy for identifying investments that could become successful exits, and in that wrap in how well you've done, right? So let's talk about some of the winners and how your strategy played a part of that.
Very good. So the computer business, first of all, started out as the code that I'd written for the record company way back when, very early code for mini computers. And as the mini computer industry accelerated, I think I did 214 businesses in the Los Angeles area alone.
Wow.
All of them licenses of code that was very similar to the record industry code that I had written. So I made a lot of money doing that. And then the 215th was a hotel. And that's all it took. I was so much in love with what I had done with hotels, kind of feeling like I was on stage, that I gave the 214 other customers to my 3 programmers and basically said, don't let them get hold of me, be good to them, and make sure that they're all happy. And I'm going into this new business here, sitting right beside you in the same office. And so that first year, I think it was $800,000 worth of business in hotels. And then it was $1.6 million, and then $4 million, $8 million, 12, 20, 30. That business became the largest hotel software business for reservations and front office in the world.
And so this is something that we approach with and address with a lot of our companies, and I'm sure you did too with portfolio companies, the ability or inability to scale. How did you scale one so quickly, and how much staff did it take to do it? So was this a model that could scale easily, that had a lot of inherent leverage, or one that was a lot of headcount that had to scale with it?
So I love enterprise software because that's what this was. And so as I got into the angel business after selling the record company in 1990, most of my investments were in enterprise software businesses, and they did very well. We're going to talk about that in a second because that gets us into the Tech Coast Angels. But as it relates to the computer business, I had 233 employees. I had most of the offices around the world near or at an airport because I flew for 43 years. And so it was easy for me to fly the company's big twin all around the country and get to my own offices without having to rent a car. And Smart. It was just a lot of fun at the same time as building this company. We had offices in, I've got to count the number of countries, but we had 6 that we owned in 6 different countries, who then had licensees, other distributors in 26 other countries, as I remember. So this was a worldwide business.
Yeah, that's great. So to help me, again, I want to talk more, just how do you differentiate, right? So you had early success, you identified enterprise software scales, it could be very profitable. How does that formulate how you pick investments historically? I don't want to say moving forward because it sounds like you've cemented exactly what that is. So what is that strategy? I know there's a method that you have, the Berkus method, for valuing pre-revenue startups, but yeah, we can get to that later because there's a discussion there and debate probably. But how do you find, if someone came to you and said, what's your investment criteria that has served you well over the last 30, 40 plus years?
This is good. And I'm really glad you asked this because things have changed so dramatically that this is how we, as 2 groups, mate together well. And it's time for me to say that you are a sponsor of Tech Coast Angels, and you are a sponsor of all of our networks, which puts you at the top with a crown. And I'm very happy to kind of tip my hat if I had it on.
Well, like all honors, we know there's responsibility that comes with it. So we look forward to figuring out where that value driver is for everyone involved.
And I'm going to get to that because I think that our 2 philosophies are coming together fast. So you asked me what happened and how my philosophy got into what turned out to be a very profitable business for me. In 1990, I sold the computer company for a lot of money to the hardware manufacturer that we were representing at the time. But many computers were going downhill. And in the end, that company got rid of its hardware, got rid of the other 23 software companies they'd bought, and they became us. And then later on, they were bought. So that's not the story to continue. In the meantime, in 1993, after running my company for them for 3 years, I began investing as a very early angel. In fact, it was so early, the term angel did not exist except in Broadway. And so I called myself a resource capitalist. That's, kind of
I like it. Yeah.
A venture capitalist. But a resource means I gave 5 things as well as money. I'm not going to cover all of that, but it's basically the relationships, the knowledge, and all those kinds of things. And I wrote a book about it.
Yeah, we call ourselves not transactional investment bankers. We're collaborative capital.
I like it. I think we're coming together fast. So I wrote that first book in 1994, called it Better Than Money, for the reason I just described. It was picked up by Howard Stevenson of Harvard, who saw this as something that was rather new. First of all, he named my method of valuing early stage companies the Berkus method in 1996, and it stuck. Since that time, there have been over 1 million businesses using that method, and we'll get to that if we have time. But 1996, it kind of blessed this whole thing, and he called his book Winning Angels. It may not have been the first time the term was used, but it was awfully close to it. And then the same year, Inc. magazine called me a super angel, and that was the first time that term had ever been used. So fast forward, I've now made 208 investments as an angel investor. About half of them, a little over half of them, with a TCA. And now we're kind of getting together with what TCA is and does. Right. So TCA, for the first 10 or 12 years, was a group of individuals that would meet and decide individually to make investments in these various companies. Let me stop for a second and tell the viewers and listeners, if there are any, that the IRR is something that we all brag about. And my IRR is about 102% today. It changes between 97 and 104. And nobody can believe that. But I have to explain to, well, not you, Lou, but to others, that the IRR is really a manufactured number. And it is from the moment that you invest to the moment that you take the money off the table for that investment. So if you as an angel invest $25,000, the typical number that angels have been investing over the years, and you make $100,000, and so you put the $100,000 in the bank, and you start again with another 25, that stopped your IRR until you start your 25 again. Okay. Now there are other methods like TVPR, the multiple of your investment over time. That's much more effective. So my IRR at over 100%, I can tell you great stories, but it's a fake number.
Yeah, well, it's that whole, there's lies, damn lies, and statistics, and that's one of those statistical measures that gets in the way of the truth.
Darn, not damn, right.
I'm sorry. I apologize. We're not on broadcast media. I can get away with it here. So
the computer company that I described to you, I sold at 1,000x, and it was big money. So that was the beginning, and it just distorted all the rest of the things since. Then there were some times, like an early investment that I made in 1994, that we made about 5x, but it was in stock of a public company that bought us. I kept the stock. It went from 5 to 71. So my IRR on that investment went to about 320x.
So that brings up a quick question too. So you did not necessarily view an IPO as an exit like a traditional venture capitalist. You would hold on past that liquidity moment.
I'll give you an example of what Sequoia did to one of our Check Coast Angels investments. And it'll give you that in spades. What you just said is true. And so I did some strange things that made some strange increases. So that entrepreneur, the one I just described to you with the several, the 230 or whatever that number of X was, started another company in Denver after he had left his company from the buyer. And he said, Dave, you were my coach as all these years in the early company that we did so well. I'm starting a LLC that'll be a sidecar to the venture investment. And I want to give you 22% of that if you'll write me a check for $30. So I wrote him a check for $30 for 22% of the sidecar investment. And 10 years later, I had given a keynote to his people, and I knew there were a lot of them. There were 300 in the room at the time, so I knew he was growing. 10 years later, I read that Vista Equity has just bought his company for, I think it was $600 million. I'm not quite sure of that, but I know that I made 330x. No, it was more than that because I made $360,000 on my $30 investment. Not a lot of money, but it was a big return as far as multiple. And so I began writing $30 checks to a lot of entrepreneurs as I sat at the table helping to found some of these companies. And one of those was an interesting one. It was early in the days of influencers, which now you've heard a lot about influencing and influencers. And this was a advertising agency that put together Coca-Cola and Ford and GM with these influencers and then made a percentage for having put them
Right.
together. And so I was really happy with that one. I exercised my options within a year because I knew this was going to be a big company. And about 11 years later, which was this year, they were bought by a major advertising agency. And well, I put them into the Tech Coast Angels as well, into my fund. But I made $500,000 for my $30 check on that one. And so the multiple there give you an idea of like
Yeah.
how
So
100% makes fun.
So you're hitting on a couple things that we feel is important in our model in public venture. One is a portfolio of opportunities,
We're
and
going to
two is
talk
an
about that.
asymmetric risk return where a little bit of money, in your case, $30, can turn into thousands percent thousand X multiples. So, and I think, do you believe, so let's go back to the 208 companies that you've backed, right? In a traditional venture model, 10%, only 20 of those would have worked over time, right? Maybe. What's been your success rate? Because I want to say without, and I'm asking this blindly, I would believe with your strategy and approach that it's probably much higher than that.
And it is. So we have an investment committee of 5. We've already made investments of all 3 funds. And so we're in harvest mode on all 3. That's why each of the chapters went into their own annual funds. So I can give you some pretty deep experience as far as the things we have learned. But more likely you want to hear what has been the IRR, or better yet, what have been some of the better returns. And
Yeah,
it
just
turns out,
overall. So I just want you to be able to, because I want to transition next into, you see firsthand your success gives you a vantage point and your wisdom in the industry of what works and what doesn't work.
yeah.
We have our own convictions about what works and what doesn't work. So I want to just kind of tease out where you stand, because you mentioned it earlier that the world's coming to our side of the table, and a collaboration with TCA makes sense now that the world's changed. So why is that?
I want to get to that, and that is very right. So I gave you a couple of examples, and there were many, many more, where I made a lot of money early on, but there was very little competition for my money. And that changed as so many venture groups, so many angel groups began making investments, raising new funds. It became harder and harder to find a real winner among all of those that were being invested in. And so when I said 208 investments, many of those were early on before there was much competition. If you look at this now, you're seeing, for example, accelerators and even incubators having demo days with 10, 15 companies being presented for investment. Turns out that even the best of those, and I'm not going to name the well-known accelerator companies, but even the best of those only get 15, 20% of them funded. It isn't
Yeah.
a lot at all. And so it's a different
Yep.
world today. These companies are having a harder time getting funded. And in the second half of 2024, a very hard time getting funded. The amount of funding events has gone down from October 2021, the height, to where we are today, the second half of 2024, to roughly 20% of the amount of money and the amount of small companies being funded. And that's where we began, you and I, to come closer and closer, because we are beginning to doubt as a group that we have the right formula that we had 20 years ago. So I'm
Yeah.
going to lead you there as soon as you're ready to be
Yes.
led.
No, I'm ready. Listen, I think so. Help me, right? So let me explain for the benefit of our audience and let some that may be TCA what we, in a nutshell, think our model is and why it works. And then I want you to comment and say yes, no, agree here, and then let's kind of dial that in.
You bet.
So we look at it as, there's common drawbacks to traditional venture being liquidity, transparency, lockup periods, fees. Those are the main ones that kind of drag down the overall performance and impact how investments are made. And then, for lack of a better term, most venture capitalists don't have a true diligence process, right? They're trying to ascertain what might work, but they don't focus enough or have a disciplined process that leads to consistent results.
Yes.
We take the vantage point of, hey, let's view the world from a very specific lens that gives us a strategy and a process. And for us, that's intellectual property. So we deal in the deep tech deep science, because we believe if you don't have the IP and don't have an IP strategy, you can't own that category or product. So you therefore can't commercialize it. But then we look at it saying, let's go public early and open up the opportunities to financing, open up the opportunities to liquidity, transparency, no fees. We're all in this together. And in this way, we strategically align so that the co-founders, inventors, shareholders, and us as the financiers or the conduit for financing all win on the same execution milestones. The company performing and successfully getting to market, whatever the product is, scaling, and the valuation being reflected in the public market. So we see that as superior. You tell me what you think the pitfalls could be in that approach, but also why that's ideally timed for what you see the evolution.
Not going to charge you for that commercial, but I think that it turns out that there is something between us, because the IRR for early angel was about the same as the IRR for early venture, about 23% per year. And that really attracted a lot of people. Then people who came into the angel community, as opposed to those that raised funds, people came into the angel community expecting to see liquidity within 5 to 6 years. My average term to liquidity, even with my high RRR, is 11 years. Wow. A lot of people leave angel groups before the 11-year point, the 10-year point, the 8-year. And so there needs to be something much more liquid than what most of the angels have experienced. Now I'm getting closer to you. So the problem has been, if we used to be able to put money into a company and expect to see great returns, and you asked me a while ago and I never answered what have the returns been for us. With 3 funds, we've had 37 positive exits, some of them very big. We had $1 billion exit and a $500 million exit in the last 2 years, among others. So there have been some big things going on. But it turns out that 44 have gone broke that we know of. That leaves, I think it's 115 if I do this right, but somewhere around 115 left. Some of those are the walking dead, and we have no idea, because no liquidity event, no information. We can't write them off unless we sell, and we can, our shares to the Tech Coast Angels or the TCA fund for $1. We have a special fund just for that to allow us to write off the difference. So this isn't the same world that it was before. We now kind of expect to have some traction when we look at a company. It's not an idea anymore like it used to be. And we expect to have revenue and profitability sometimes. What?
Yeah, that's crazy. So then what our approach is, we've done nothing exclusively for the last 27 years but finance and bring public ideas that have been turned into companies that were pre-revenue. If I came to you 10 years ago versus now and says all we do is take pre-revenue companies public, would you believe that's possible, or what would you say to that strategy?
Well, there was a time when this was absolutely possible. With only 5 public offerings last year, IPOs last year, it was an awful year. And so I'd like to tell you that that would have worked beautifully before. And last year, it was a challenge for all of us. Now, I'm not speaking about the pink sheets. I'm speaking about one of the offerings on NASDAQ or New York.
Totally agree. Yeah, I don't consider a liquidity event on the pink sheets or over the counters as actual, getting public, right? It's got to be NASDAQ or NYSE American or even TSX Venture potentially. Okay,
so we are in alignment on that. So now as I get closer between the two of us, I'm talking about the frustrations of angel investing today as opposed to 10, 15, 20 years ago. And the frustrations are people leave before the liquidity event. Annual funds are being invested into whatever was the company du jour. And it isn't quite the same as taking your time and investing over the 5-year period that we who have sent funds before have been able to do. And so what happens now? Demand for some kind of liquidity event, demand for some kind of positive exit, demand for information, which we have been finding from half of our companies we don't get after a while, unless they need money.
It's funny. It's like kids that grow up and they don't call until they, it's a cash call instead of just a check in.
So here's TCA Fund trying to figure out how to grow up, because as we were before, we were making 23%. And in fact, John Harbison, who is the person who is a member of our fund, member of TCA, who keeps our statistics for us, tells us that if we had invested $25,000 in each of the 450 companies that we have invested in over this 24-year period, we would have had a 23% IRR. And doesn't that sound familiar? But nobody's
Yes.
going to invest 25 grand in every single company. And so very few people come up with anything like that. Now, I've been lucky, but that was mostly from early investments, not from the more recent ones, although I've told you about two very good ones this last year, which
Yeah.
changed some
No, but
things.
that's a good distinction that the world has changed because a lot of your big winners were earlier where you could see value where others didn't. There wasn't as much competition. And we see the same. And on the other side of, who finances early stage micro cap, small cap companies, they don't have a quality screen process. So most investors' experience has been negative, not positive. And what do you think changes, right? So we're kind of talking about as our worlds are moving closer together, the overall sentiment in the market is not, the tailwind. There are no tailwinds. They're mostly headwinds right now. But what do you think changes that? So you strike me as someone that's more than likely more optimistic than pessimistic. So where's the opportunity in the overall market malaise right now?
So I have my own podcast. And during the last couple of podcasts, we reviewed the Silicon Valley Bank report for the first half. We reviewed one of the other very good reports and dissected them both. And I've had this feeling for the last 2 years of malaise that the private equity market will come back mid 2025. That is becoming pretty
It's
obvious
happening.
now. Mhm, it
Yeah.
is happening. And so the number of investments that I mentioned a while ago that were so low during the first half of 2024, I think there is such a buildup of invested cash waiting on the sidelines that we're going to see a lot more invested once we begin to see the interest rates drop a couple more times.
Yeah.
And I'm thinking that happens mid 2025. So
So
we will.
when do you think, again, because I get asked on this every week, what's the Fed's next move? Do you see interest rates coming down any more this year? You think that's a between now and mid 2025, we get to call it 200 basis point reduction?
All right. So I'm thinking that we're going to have, well, not 200 basis points, but I'm thinking we're having a 50 basis point reduction before the end of the year.
Okay.
And I'm thinking we'll have about 150, which is a lot, by mid 2025.
Yeah. So there's our 200. That's what I was trying to convey. Between now and mid 2025, is it about 200 basis points that you see it coming down?
Yeah, I'm saying a total
Yeah.
of 150. You're saying a total of 200. Let's not argue it. The point
Okay.
is that's going to release a lot of money on the sidelines. It's going to
Yes.
release some IPOs that have been waiting on the sidelines. That's going to help you. So now how are we coming together? We have a group that is primarily frustrated for the reasons I just said. No liquidity, not enough in enough time, and certainly not the expectations that many of the angel investors expected. So we're talking about investing in, now we're going to start filling in the blanks. Early public companies, Lou,
Yeah.
investing in real estate, investing in other entities that are further along than we had invested in the past, coming
Yeah.
along with venture groups as sidecar funds, doing
Yeah.
anything where we can see earlier investment. Because here's a problem. If we, in the old days, invested in a very early stage company, as we all did, and then a venture group comes in, particularly one of the bigger ones like Sequoia, they would reset the clock. So we might get 5 years into it before they were interested. They would reset the
Right.
clock for another 5 years or more. So our poor members were waiting for 10 years for liquidity, sometimes even more than that. Remember, I told you
Right.
mine's an average of 11.
11. Yeah. 11 is
Yeah.
your average. So
So now you know
no,
why. So
yeah,
we
no,
have
that
we
makes
have
it
to.
makes imminent sense. It has to be, I think, especially now in a day that's, I mean, you followed the technological progression, right? Everyone's used to on demand, not waiting. Patience is not a virtue. So I think
Yep.
it's trickle down economics or capitalism into the venture and venture stage investing world. They expect more sooner. So
So I just gave you 4 different areas where we are exploring investing that we never would have explored before.
yeah,
In the early days, we would take an idea, and I'm going to describe one to you now because it's one of my favorite stories, and we would make that idea into something by financing it. Today, we would never do that. It has to have traction. It may have to have revenue, as I said. And
yeah,
that means the earlier stage is having a hard time getting financed because venture
yeah.
groups and early angel groups were the way.
Yeah, no, and look, I think our big tagline is we launch big ideas. We love to find them and then finance them, but we are finding that because there's a lack of investment in that space, we can acquire those ideas or at a much more compelling valuation, which then sets us up. But it is, there's a lack of competition on that side, but there's also a resistance from investors for how long is the hold period? How long is it going to take to get this idea turned into a commercial enterprise that is moving towards scaling. So I think it's like always, right? When the bargain, it's hard to buy low because there's reasons that valuations are cheap, but that's usually the best times to buy. So we find good opportunities, but then it's got to find the right investors as well. So with that being said, look, I want to open up again, be respectful of everyone's time. I want to open up to question and answer at this point. We'll finish that up. We'll do some back and forth, and then Dave, I will give you, final comments and prognostications on where we go from here, what you think are the opportunities, and then we'll go from there. So everyone, again, the Q&A function is live in Zoom. Please go ahead and populate any questions that you may have right now. We've got a couple in here right now. I'm going to go ahead and share. The first one we have is, just to be clear, so would TCA look at public companies that are still early stage in tech development or in pre-revenue IPOs? Is that the preference? So I guess would you make investments in TCA in public, or do they have to be exclusively in private that are about to go public?
I made my money because the average pre-money was about $1.5 million back in those days. And so if you have $1 billion exit from $1.5 million in, and you had only taken in 5 to 10 million in the meantime, you make a lot of money. Today, the average is 5 to 7 million for these young companies. And so if they're selling for 35 to 40 million, you're not getting the same kind of returns and multiples that you would have had. So the answer to that question is, now we have to look for other things, one of which may be early stage, maybe even pre-revenue public companies, because first of all, they're liquid. And that probably solves the biggest problem we have, is illiquidity for all those years.
Yeah, no, that makes sense. And I think too, it underscores the valuation, right? It's when timing matters and valuation matters, and that impacts your end returns, which we see in the real estate market a lot. Question here too, why would TCA stray from their comfort zone, particularly in a space where multiples are nowhere near angel status?
Let me think about that. I'm not sure that that's as clear a question as I'd like, but why would we stray? It is because if we were trying to make investments in pre-revenue companies and finding that the time to liquidity was so long, longer than many of the members wanted to remain members, there had to be a reason for us to look for other things to keep them interested and keep them as members. By the way, can I add that of these three funds, one of the prerequisites is you had to remain a TCA member at the liquidity event to gain the carried interest. And so Fund 2 just paid out a lot of carried interest to 6 members out of 60, I'm sorry. 10% of the original members were still around, and they divided the pot.
Yeah, no, listen, I think that's the struggle and opportunity in these things that we do. We had a company, our last very big exit was one that we funded at $25 million pre, got taken out about 6-7 years later at 2.9 billion. And there we had a lot of people that held on the whole time, but a lot of other people that didn't, right? So you don't get all the rewards. I got a really interesting question here because it's going to ask you to use your expertise to evaluate us. So I'm really intrigued by the potential answer here. So this comes from one of our faithful shareholders. MDB, if you know it or not, I think you do, is a publicly traded company.
Yes.
We have an equity interest in all the companies that we back, some sizable. The bigger the idea, the earlier stage we got involved, the more interest. But then the public companies we finance, we take our fees in, or a good portion of them in equity. So with that understanding, what would you look at if you had to value our stock? How would you try and determine the value of our stock? And especially this investor saying it seems the market right now is having challenges figuring it out.
First of all, everybody is undervalued today. And it's because there's no liquidity.
Hold on. Say that again. I want to get that.
I'm going to say it again. Everybody's undervalued today. And the problem is, if this were a railroad train waiting for the engine to get through the IPO, that engine ain't going nowhere yet. And so there is such a backlog right now, all the way down the line, that many of us aren't investing because we know that there's no liquidity event for a while. And once we see liquidity events, boy, the floodgates will open. That'll be true for a lot of these undervalued public companies as well. There just hasn't been a lot of trading in the lower valuation public companies. That will change. Um, that's why I said no
Yeah.
pink sheets, because I want to have companies, if I can, that have some traction, have enough shareholders, and at least a market maker so that there is liquidity and opportunity for much growth.
Yep. Yeah, no, that makes perfect, eminent sense to me as well. Two more questions here, and then we can wrap it up unless there are.
Okay.
One is just as you're looking at real estate now, is it commercial real estate making a comeback, or are you looking at retail housing? Which side of the market are you most interested in?
I'd have to give you my personal answer, and I'm not going to do that. So TCA is just beginning to look at the idea of investing in real estate. We have done none of that so far, so it's not really a question I can answer yet.
Okay, so to be determined based
To
upon
be
the
determined.
opportunities. That's
Mhm.
right. All right. So here's a good question. We talked about it before. You considered yourself a resource capitalist. You're not just bringing investment capital, but
Right.
resources along with it. How does TCA support their investments? Are there formal ways that are, memorialized in a contract, or just how are you being collaborative with the companies that you back?
When we were backing these early stage pre-revenue idea type companies, we would always take one or two board seats. Nowadays, there are more investments. Members aren't taking board seats as often, although it's probable that if we were young enough in an investment, meaning if we put in 500,000 at a pre-money of 5 million or 4 million, we might take one board seat in that case. So taking a board seat is a very big part of this. I'd like to say that I probably became the CEO coach of at least 20 of companies. I've been on more than
Yeah.
40 boards, but those days are pretty much past, partly because of worries about exposure as a board member.
Yeah. Liabilities. Yeah.
Yeah, and so I think that has changed. I've been sued 6 times as a board member, but that's a set of stories I'm not going to tell today. But in each case, I
You
won.
live to tell the story, though. So that's the good thing, right?
Yeah. But, there's a lot of irrational behavior going on in the early stage when people lose it.
Yeah.
So another day for another interview.
Yeah, I'm going to end on one because I think this still becomes the hardest piece of the puzzle to unlock, right? So we can have a discipline strategy, a criteria for what we invest in, invest with a discipline at certain valuations, but controlling or handicapping the human element, leadership, management. How have you dealt with that? Because that can either make or break. You bet on the right horse, but you get the wrong jockey. How do you make sure that you have the right jockey on the right horse? And if you don't, what do you do about it?
Okay, so the jockey and the horse has become so trite that for us
I
it's
agree.
pretty hard to not laugh when we. But it
Yeah.
turns out that it is almost always betting on the jockey, almost always.
Okay.
So
Always
if
on the
we have a
jockey. So
great
we would
team,
take so we would take the stance that you could have. So in our model, we think you got to have the right horse, and then replace the jockey if you end up with the wrong one.
and we say the right jockey, meaning the team, because we know that at the early stage, 100% of those companies will pivot. And if they're going to pivot, it better be because it's good management. And if it's not,
Yeah. No.
then we've got a problem.
Yeah, no, I would agree with that. I think, we always say it usually takes twice as long and twice as much money, but I think I can completely wholeheartedly agree with the fact there's always going to be a pivot, right? There's never perfect information. You just got to move forward and then adjust as that information becomes clear.
Yep.
So, well, listen, I think we've reached the bottom of our Q&A. We've reached the kind of the time limit that we said. I think there's probably a million other directions we can go in that would be fruitful, but we'll have to save that for another time. Dave, I want to personally thank you. Super enjoyable, engaging, insightful. I want to leave last words to you too, and just thank you and TCA for being willing to partner and work with us. And we're hopeful of what's to come of this relationship. So, I'll give the sign off to you.
Thank you, Lou. Well, TCA is one of the oldest angel groups in the country, and certainly one of the highest in respect. And so with 400 members today, it's one of the leading groups as well. We look forward to this partnership that you and we have put together, because as I've mentioned, and I think I've made the case, we've got to be looking for more liquidity and different ways to make our investments. So I look forward to a great future with you, with MDB, and seeing that we can do a lot together with the early stage and with public.
Well, couldn't have said it better. So thank you, Dave, and we will certainly speak again with everyone. Thank you for your time and attention. If you have any questions afterwards, please do not hesitate to reach out. If you need to get in touch with Dave, I'm sure you can readily find him at berkus.com and at TCA's website. But if you have any troubles, reach out to us and we'll make sure to connect you. So thank you, everyone. Here's to a fruitful, enjoyable week, and we'll be in touch soon.